Edutrainment Workshops, the insurance industry's leading education and training platform, presents Life Insurance, the entry-level series, the products, the underwriting, and the planning applications to position your practice as the premier provider of insurance products in your community. Get on board, get on track, get to where you're going. And now, your Edutrainer, national insurance columnist, Steve Savant.
Well, welcome everyone. I'm Steve Savant, your Edutrainer and coach for our Edutrainment Workshop series. And this week and all for the next month or so, we're going to be doing our introduction, our entry-level introduction into annuities. And it's a whole new foray. Maybe you're coming from property casualty, maybe you're coming from the banking scene, maybe you're coming from securities, maybe you're a life person, a life agent, but you really haven't done much annuities. Whatever it is, we're going to try to walk you through the basic entry level. And today, in this episode, we're going to be talking about the idea of the history of annuities. Now, I have to tell you, I was a little bit shocked because I know we were doing annuities back in England in the late 1600s, but I actually found evidence that archaeologists actually recorded discovering some type of an annuity all the way back into 1700 BC. I was kind of taken back by this. When I saw that, I saw this in the Egyptian code, and they kept some of these writings in here, and some of the basic premise, which is surprising to me, payments or amortizing, making payments, this theory, this idea of making payments was already happening. So I was pretty blown away by that. But we really don't get into what we call true annuities until about the Roman Empire. And they use the Latin word annua, which means an annual stipends. It's a Latin term making these payments, these stipends, these amortized kind of payouts or distribution. And back then, Roman citizens would make a one-time payment into an annuity or an annua, and in exchange for lifetime payments made once a year. At that time, they didn't have the kind of things we have, like a monthly payment, quarterly payment, semi-annual, or annual, but they actually used an annual payment. Interestingly enough, the government did this to fund certain areas. And by the way, we're still kind of doing that in a way, but let's move on. About the 1700s is when we really started seeing the use of annuities, especially in Europe. And most of the time, the governments that were involved were using these annuities to fund mostly campaigns, mostly war campaigns, and then some upgrades in civil and municipalities to try to make bridges and buildings and so forth. But most of it was done for war. So people would contribute into that, and they invented this thing called tontine. In 1693, this whole idea was called the State Tontine. It was an annuity type, and that annuity, a person could buy one of these tontines, and they would get an annual payment for the fund for the lifetime of a specific person. In a modern annuity, a person gets one for themselves, but these English tontines were a little different. The person buying the share could actually designate a different person as what was known at that time as called the nominee. Now, I find this really interesting because we always are looking for the issue of who will be the annuitant, who will be the beneficiary, who will be the owner. Those are the big three things. We're going to get into that sometime next week. We'll walk you through all the players and what it does and all the tax consequences that surround it. But when we're talking about this is really remarkable because back in the day, this is how they did these things. And most of the time when they used a tontine, they actually did it with a child so that you would have maybe a joint or a child only, and the actual payment would be for the length or the lifespan of the child. Now, back in the day, human mortality in 1693 in England, the average Englishman only lived to age 47. So it doesn't really sound like a lot of time. Today, if we use that same boilerplate idea, and we actually do use it somewhat in single premium immediate annuities that are in life-only option, think about the longevity we have today. Every day, Willard Scott says happy birthday to some American that's turning 100. If he took the time to say happy birthday to everybody that's turning 100, it would take him 90 minutes a day, 7 days a week to be able to do this day in and day out all throughout the year so that he could say happy birthday and celebrate all the geriatrics that are coming into the Centurion Club or the age 100. When I think about the actual expansion of longevity, we are living in the longest mortality revolution that the human race has ever seen since the early days after Noah's flood. Now, when I'm looking at this, it's interesting. The payments would continue to be paid out for the nominee, or like in my example, a child. And then finally, when it was done, there was one last payment, and that was it. Now, of course, if the child died early or something happened to the nominee, just like we would do today, single premium immediate annuities, once death occurs and there's no other beneficiaries to share it with, the money would be gone. So people would look at this as an annuity payment for life that they couldn't outlive. The same theory is still true today. And what we're doing now, especially with human longevity, is I want you to start thinking of not only annuities that we'll talk about next week that have time certain horizons, 10-year perhaps, 10 or 20 years perhaps, but even lifetime or joint lifetime for married couples if you wanted to go that far. You could go ahead and see how long that payment would go. And the older that the payment is bought, let's say age 70, I've noticed that certain credits are applied, certain mortality credits, and those credits can actually sometimes outperform the actual interest rate because the timeline of the client is shorter, so the payouts or the actual mortality credits are now accredited onto their balance sheet, and it actually looks a little higher than whatever the prevailing rate is. And that's the beauty of using mortality products and giving credits depending upon when the purchase of the annuity is made. So the older I am, if I purchase it at 70 and my life expectancy is 90, I might be able to actually beat an indexed income rider, depending upon which rider I'm comparing it to. And again, we're going to get into all this, just giving you an example, because of my lifetime, my lifespan. So when I'm looking at these systems, even back in the day in 1693, they had the same philosophical issue. And remember, Sir Edmund Halley is really responsible for really building and constructing our first usable actuarial table. And annuity is, just like life insurance, a mortality product, whereas in contrast, morbidity products are like long-term care, medical insurance, disability. Those are the kind of what I would call truly morbidity products, but we're dealing in mortality products, annuities and life insurance. Now, participants in these early programs would always share in this tontine that the UK or the England would actually give out. And in return for the owner of these shares, they'd give the lifetime benefit to this child. Now, when the child died, the growth and division of wealth continued until there was no nominee left. So they could have multiple bennies. And even today, when we use it, we could have a beneficiary and then a contingent beneficiary. It could be several beneficiaries depending upon how we want to frame and make sure that the people that we love or the people that we want to bless with an economic annuity or a payment or a distribution would go on forever. Now, interestingly enough, the first time we see annuities sometime in America is about right in the 18th century, about 1759. A company in Pennsylvania was formed to benefit Presbyterian ministers. And by the way, they did life and annuities back in the day. And that's really the first what we call stock company or stock life insurance company, and they sold annuities. And the ministers would contribute to a fund in exchange for guaranteed lifetime payments by the fund. And it wasn't until 1912, about 100 plus years later, that Americans could buy annuities outside any kind of quarantine group. It could be maybe your business, it could be in this case a minister's fund, but until that time you couldn't really buy it unless you belonged to a fraternity or some kind of a group. Then in 1912, insurance companies started to be able to offer it to individuals. And annuity growth from that time on was steady. But annuities always didn't really catch on until about the late 1930s. By the way, right after the Depression, people were so blown away by the losses of the stock market and how it plunged America into the greatest economic depression that we've ever known since our creation as a nation. And when you think about it, in the 1930s, people wanted guarantees. Well, we just came through one of the worst recessions in modern history. Can you imagine when you think about it and comparing it back then? This is called the Great Recession. It could have been the Great Depression round 2. And what people are looking for now, what baby boomers are looking for, what Gen Yers are looking for, what Gen Xers are looking for is part, maybe not all, but part of their portfolio absolutely positively guaranteed and having a contractual provision in there where they'll never lose their original principal. That's how hot it was back then in the day. It's still a concept. You can't change human behavior and the longing to have some kind of financial security. Annuities bring that to bear all day long, and there's so many different annuity chassis that we're going to get into next week. We'll walk you through it, we'll map it out for you so that you can see everything that's out there and what you can get, and part of that provision, part of that what I would call the wonder of it all from an annuity point of view is the preservation of principal. So when I'm looking at this, I really want to look at what part of my portfolio, and should I be using what form or what kind of index? Now, I noticed that right around after the Great Depression, a lot of people started looking at annuities as a sinking fund, or actually the phrase they used was rainy day. During the New Deal program, oddly enough, FDR unveiled several programs that encourage individuals to save on their own retirement. Interestingly enough, FDR is usually looked at as a progressive, but he actually was trying to inspire them to get their own individual retirement plan back in the day so that they could be secure, because he knew that even with the advent of Social Security, it could never actually pay for a person's complete retirement. It was just part of a solution. It wasn't the entire solution. And all we are now sitting in the 21st century is we've come to that conclusion now as well. We not only get Social Security, but we also have to do something on our own to make sure that our golden years are really golden. Now, when I look at this, and especially when you think about that was FDR, when I look at today's standard, the first modern annuities were really quite simple and straight up. Today, you need legal understanding, you need tax code understanding, you need to know some math and why it works, you need to know the difference between actual gain and actual basis, and that we live in the land of taxation called ordinary income tax. We'll get into all that this week. We'll kind of introduce you to that. In 1952, though, interestingly enough, and most people think that variable was invented sometime in the late 80s, but actually the first variable contract came on the scene in 1952. And variable annuities credited interest based on the performance of separate accounts. This is the first time we hear this phrase, separate accounts. On all these other accounts, they're the general accounts within the carrier's own balance sheet portfolio. So the carriers own this, but in variable, they're really segregated, and these separate accounts are separate. And that actual language, surprising to me, actually started in the early 50s. So our first VA was built back in 1952. Now today, annuities are so huge that we're looking at probably an estimated over $200 billion. In fact, on a couple shows back on the Business Insurance Zone, I actually made a comment by saying that 46%, almost all group 401ks have some form of group annuity into it so that they can have a part of their contract somewhere in there. There's some kind of guarantee. Some might be principal, some might be high watermark, some might be death benefit. But you can purchase these, or some of them are embedded in the contract. It just depends upon which one it is. And remember, everything has expanded, and we're trying to cover off all these eventualities and, again, the longevity that we're living with now. When I consider that we built the 2001 CSO for product construction, and so we construct our annuities, we construct our life insurance off that. But we've already upgraded when we do regular retirement modeling and estate planning and transfer to the next generation. All those are built now. We're looking at the 2008 Society of Actuaries VBT tables, which we think are much more current and a lot more accurate. Although every year we go by with medical advances, how accurate can these actual mortality tables stay? And remember this, that some annuity contracts in a life payout actually will manage your human mortality based on your health. Oddly enough, think about it. You have a single premium immediate annuity. You put down a lump sum and they make payments and guarantee it for your life. But if your lifespan is going to be shorter, maybe perhaps because you're a type 2 diabetic, or perhaps you have cancer or another cardiovascular event in your life and your timeline now is actually shortened, they actually take things like that into account and map out what the timeline is. The shorter the timeline, the bigger the actual benefit. The longer the timeline, the thinner the benefit. Oh, and I'm putting two people on one contract? Well, I have a certain amount that I would get if it was just myself. My wife would have a certain amount if it was just hers. But if we put ourselves together, then it covers both of us. Now, remember, you're giving up some of that so that both are protected for their life. And think about it. My wife, being a baby boomer, she is going to live well into her early 90s. When you think about her health, she wants to make sure she has guaranteed income she can't outlive. She's going to get some Social Security, but we can't depend on the government to pick up our tab for our longevity and our retirement. So we're looking at things like this all the time, doing joint annuities for payouts that we can't outlive. It's retirement guaranteed, and it doesn't matter if she turns out to be the Guinness Book of World Records who died about 7 years ago at 122.
This has been an Edutrainment Workshop, the educational division of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance.